Welcome back to FitWit. This is Namrata Singh. This is the one destination for all your queries on food, wellness and finance. Today I'll be talking about mutual fund taxation and its impact on personal finance. I'll also be talking about the recent finance bill amendments and its impact on mutual fund taxation. Mutual fund investors earn income or profits either as dividends or as capital gains. Dividends, as and when paid by the fund houses, are fully taxable in the hands of the investor at slab rates. In fact, the fund houses are also liable to pay TDS at the rate of 10% in case the cumulative dividends for an investor exceeds Rs 5,000. The dividend income thus received by the investor is added to his total income and is categorized as income from other sources. Capital gains in mutual funds will arise when the mutual fund investment is sold at a price which is higher than the cost of purchase. So, the capital gains tax liability would arise only when the investment is sold and not before that. Moreover, the tax liability would be dependent on whether the investment is into an equity-oriented fund or a debt-oriented fund. From the taxation perspective, any mutual fund scheme which holds more than 65% of its assets into Indian equities or equity-related instruments is construed as an equity-oriented scheme. All other kinds of funds would be construed as debt-oriented schemes. You can refer to our earlier videos on debt and equity mutual funds for more details. Equity-oriented mutual funds are construed as short-term if the investment is held for less than 1 year, and they're construed as long-term if the investment is held for more than 1 year. Short-term capital gains tax rate for equity mutual funds held for less than 1 year is 15%, and long-term capital gains tax rate for equity mutual funds held over 1 year is 10% over 1 lakh. So, up to 1 lakh, there is no tax on long-term capital gains. Say for example, you have generated a long-term capital gain of 1,50,000 by selling a equity mutual fund. There would be no tax on the first 1 lakh. You would have to pay 10% on the remaining 50,000 rupees. In my view, 1 year is too short a time to invest into equity funds. One should invest into equity mutual funds with a horizon of at least 5 years and more. The recent amendments in the finance bill has had the biggest impact on debt mutual funds. The indexation benefit available on debt mutual funds held for more than 3 years has been removed as per the latest amendment. Let me explain this. So, prior to 1st April 2023, debt mutual funds enjoyed taxation benefit wherein an investor who was holding debt mutual funds for more than 3 years paid a lower tax thanks to the cost of inflation index benefit. But that benefit has been removed by the government. Now, debt mutual funds are literally at par with fixed deposits over a 3-year period. Capital gains arising out of this redemption of debt mutual funds will be taxed at slab rates. This rule also applies to fund of funds which invest into international funds or international markets, gold funds, silver funds. All these funds have also lost the indexation benefit that they used to enjoy prior to the 1st of April. Irrespective of the tax laws applicable on mutual funds, your decision to invest into mutual funds should be in sync with your risk appetite, investment horizon, and financial objectives. If you like our video, kindly subscribe by hitting the bell button below. For all your queries, please write us at fitwitglobal@gmail.com. Thank you.